Well, if the market is going to be taking a breather, it may very well do so right in this area. That's what we're going to talk about on today's Stock Market Brief show. Even today, we saw a lot of green on the screen. So I'm not trying to be the party pooper, but I kind of am. We're going to talk about that on today's Stock Market Brief show, where we navigate the financial markets through the lens of technical and intramarket analysis. If you haven't done so already, make sure to hit that thumbs up. That's how you sponsor today's episode. Let's get into the show. All right, people, check the pinned comment. That'll give you some information on my swing trading community if you haven't seen it already. It's through Patreon, but I post everything on Discord. You sync Discord up to it. You put the left into the right, and then you plug it in right over here, and then you're good to go. There's also a link to download today's chart deck if you want to take a look at the charts. Overall, if you take a look at the 11 sectors that make up the S&P 500, we had a good risk on day today. XLK and consumer discretionary led the way, up 1.32% and 1.12%. So why am I over here talking about party pooping in the market, potentially pausing off? Well, if you're on today's live stream, you would have probably seen us trying to get for that strike over here at 5,000 in the S&P 500, and it is a large strike to be aware of. And this is where price can get hung up, it can get pinned before we have some option expirations. And option expirations, it looks like February 16th, we have a little bit more of expiration taking place there, 24%. And then this Friday on the 9th, we have about 18% rolling off. So still not that much comparably to how much GAM is here. So we can get stuck up in this area potentially for some time or even push away from it. If you take a look at the seasonality charts we shared on the other episode, we're moving into a period of seasonality where we do get weakness. We're right here on the green line. We're right about where we peak in February, and then we have some weakness into March before we bounce back from a seasonality standpoint. The same thing goes with the NDX. You can see we're coming up into a period of weak seasonality, but that's not all. Take a look at the volatility index seasonality. This is the VIX. You can see we spiked up, and we're kind of coming into the area where you might get a spike in volatility. Now, if I take a look at the S&P 500, we did hit that 5,000 level, but it was on the CFD chart or Owanda. Okay, not on the, just if you pull up SPX on like Thinkorswim or so forth, we missed it by about 11 cents today, but you can see we came up into that area and we kind of pushed from it. So in order to get the 5,000 on the main SPX chart, you have to get just slightly back above it. But even if we get back above it, I would expect that we're going to be around this area for quite some time unless something very dramatic happens to really escape this level and push higher to the higher strike, which the higher strike, the larger strike that's growing is at 5,100, but still it's only about half the size of this 5,000. If we take a look at the S&P 500, the SPY, on the 15-minute time frame, we are above a week to date, month to date, year to date anchored VWAP. We're above a rising 5-day moving average, and we have not tagged the weekly expected move as it stands. We have tagged the weekly expected move for like the last 5 or 6 weeks or so forth, maybe even more than that. So there's a high probability that we do come into one of these expected moves. That could be up here if we go to that 5,000 marker, or we're potentially down here if the 5,000 gamma strike level starts pushing us back down. Just understand that it is in bullish context here, and then we're above the gamma flip line. So check for the bulls, and then above the rising 5-day moving average is also a check for the bulls. It's when we get below it, it's a little bit more scary, okay? But I know some people like to fade trade, and if it gets extended, they like to fade into it. And this would be a potential area, right, to just be aware of as price could get hung up. And that's not only the only expected moves that I pay attention to. I look at the monthly expected moves, and you can see here the high was at 4,999.89, so about 11 cents from hitting that 5,000. And you can see we are at the monthly expected move, and it is the 7th of the month, right? Last month, we got outside of it a little bit, but we ended up pushing back and closing within it because from a probability standpoint, there's 68% of the time that we close within here. So by month's end, it's basically saying, hey, we'll close where we're at right now or potentially lower. That's what, just from a probability standpoint. But remember, this is February. We still have one more month left in the quarter, and the quarter expected move is still nicely above us. Same thing with the Qs. The Qs hasn't tagged it, but it looks like it has. It's still a little bit higher. The high was like 432, and I think the expected move is like 433, 34, 35 or something like that. So slightly above it. But we're coming into that upper expected move. The one that hasn't moved at all is the IWM. The IWM had an inside month. We're above a rising 5 monthly moving average, and now we're having another inside month. This red shaded area down is actually minus 20% from this high. So we're sitting around in bear market territory still for the Russell 2000. However, this is consolidating nicely. So if we can stay above this rising 5 monthly EMA, this at least opens door, which is about 190, right? Or right around 190 is 189.50, we'll call it. That would, if we can stay above that, that can be positive. Now, if we start breaking below the low, then that opens the door to 180 and the lower quarterly expected move there. A couple of divergences that we've been talking about, for example, smart money up here, the bond market, right? Since the start of 2024, going into 2024, right? It had its high right before then in December of 2023, and it hasn't actually made a new high, while the SPY, right, has continued to press higher along with like the Qs and so forth. So this right here is a divergence worth noting, because there's been many times throughout history where we can go back and say, hey, if smart money's putting in a higher low and dumb money, right, the SPY is putting in a lower low, the smart money's telling us, hey, we might see strength, and we see strength. And same goes over here where we saw a lower high and a higher high that says, hey, maybe we can see some potential weakness. And well, we did. There's also a couple of divergences building that we talked about in the prior episode. We have the negative divergence building in the RSI, but remember, we're still above a rising 5-day moving average. So it takes some time. You can call this a rising wedge. You can call it whatever you want, but it is diverging, telling us that price is moving higher, but the internals right here, as far as its indicator goes, is weakening. And then you can see right over here, this happened in 2022. But what's been really driving this market? The market has been driven by a few names, and those are the larger market cap names, mainly NVIDIA. So if we take a look at something like the semiconductors ETF, like SMH, you can see here, very similar to the SPY chart, we had a negative divergence going into 2022 when we saw weakness. It played out to the downside. We have a negative divergence building here into August of 2023, and it played out to a correction to the downside. Well, as it stands right now, we have a negative divergence building. We have a higher high, and we closed at basically an all-time high, I believe, over here, and we have weaker internals. So is this telling us, as we're moving into these key levels, we're moving into weaker seasonality, bullish seasonality for the VIX apparently, is this telling us where we might actually have a red week in the near future? And, you know, you can see here we've had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15 weeks so far that are currently green candles. Sorry, 14 out of 15 weeks. So are we coming into an area where we're going to be going in through a period of consolidation? Time will tell, but remember, we're still in overall a bullish trend on the weekly, daily, 15-minute time frame. So just be patient, be cautious as to where we're moving, because it does seem like the risk is building to the potential downside, more risk to the downside than there is actually reward to the upside. That's all I got for you on today's episode, everybody. Be careful, be safe. Have a good night.